All right, let's talk about the one number on Wall Street that can literally make or break fortunes overnight. Seriously, it can send a stock rocketing to the moon or crashing back down to earth in a single day. It's not revenue, it's not even total profit. It's earnings per share. We call it EPS. It's supposed to be the ultimate scorecard. But what if I told you that this number, the most powerful number in finance, is also one of the most misunderstood?
You know why? Because that single simple number that everyone obsesses over, well, it's built on a secret. A secret that has way more to do with psychology, a little bit of accounting magic, and a really high-stakes game that gets played every 3 months. So in this explainer, we are going to pull back that curtain and see what's really going on with EPS. So let's start with the basics. We need to understand the illusion of simplicity that makes EPS so powerful in the first place, and, you'll see, so deceptive.
On the surface, basic EPS seems totally straightforward, right? It's just the bridge connecting a huge company's massive profit to what it means for you, the person holding just one share. It takes that whole pie of earnings and tells you exactly how big your slice is.
And the formula, it looks easy enough. You take the company's total net income. Then you subtract out any dividends they've promised to preferred shareholders. See, those guys have a special deal. They get paid first. Whatever profit is left over belongs to us, the common shareholders. Then you just divide that by the number of shares out there. Simple, right? Well, maybe not so fast. Because this is where we find the very first crack in that simple facade. Turns out the number of shares a company has isn't always a fixed number. It can change. And that leads to a huge question. What about things like employee stock options or those special bonds that can be converted into stock later on? These are basically promises to create more shares in the future, which means everyone's slice of the pie is going to get smaller. And guess what? Basic EPS just pretends those don't exist.
And that is why the pros always look at something called diluted EPS. Think of it this way. Basic EPS is the optimistic sunny day picture of right now. Diluted EPS, on the other hand, is the more conservative, worst-case scenario. It answers the question, what would our earnings per share be if every single person who could get new shares did? It factors in all those options and convertible bonds. And that's why diluted EPS is almost always lower than basic EPS, and it's the number that serious investors actually pay attention to.
Okay, so now we know there are two different kinds of EPS. Let's get into the real drama, earnings season. This isn't just about a company reporting a number. Oh no. It's a full-on psychological game, a high-stakes performance put on for an audience of analysts and investors. So before a company reports, all these analysts come up with their forecasts. The average of all those official predictions is called the consensus estimate. But then there's the whisper number. This is the unofficial number, the real expectation that's floating around among professional traders. And studies have shown it's often way more accurate at predicting how a stock will move. A company can beat the official consensus number, but if they miss the whisper number, that stock can still get totally crushed. So get this. Here's a wild statistic for you. In any given quarter, something like 78% of all the companies in the S&P 500 report earnings that are above what the official analysts were expecting. A beat, a positive surprise. Which brings up a pretty obvious question, right? How? How is it possible that nearly 4 out of every 5 of the biggest companies in the country are consistently surprising Wall Street? Are all their CEOs just brilliant fortune tellers? Or is something else going on here? Well, the answer is this carefully choreographed dance called the earnings walkdown. It perfectly shows the game being played. It starts at the beginning of the quarter with analysts putting out these optimistic forecasts. Then, partway through, the company comes out with some conservative guidance, hinting that things might be a little tough. So what do the analysts do? They walk down their estimates. So by the time earnings day actually arrives, the target is so much lower that it's incredibly easy for the company to just step over that bar and declare a big surprise beat. It's like being a high jumper who just keeps lowering the bar to make absolutely sure you can clear. But you know, managing expectations is only half the battle. Companies also have a whole magician's toolkit they can use to actually engineer the perfect EPS number itself. And the most powerful trick in that whole book is one that makes the EPS number go up without the business actually getting any better. It's a little piece of financial sleight of hand called the share buyback. Just look at this. It's pure math. Let's say a company makes 10,000 crores in profit, and it has 1,000 crore shares out in the world. Its EPS is 10 rupees. Simple. Now, what if that company uses its cash to buy back 100 crore of its own shares? The profit is exactly the same, still 10,000 crore, but now you're dividing it by only 900 crore shares. And presto, the EPS magically jumps up to 11.1. It looks like the company is growing, but its engine isn't running any faster at all. It just cut the pie into fewer, bigger slices.
And beyond buybacks, EPS is also open to all kinds of accounting games. These here are some of the biggest red flags you got to look out for. For example, if a company's reported earnings are always higher than the actual cash coming in the door, something's fishy. Or if a company keeps reporting adjusted earnings that exclude these so-called one-time costs that, funny enough, seem to happen every single quarter, well, they might just be trying to hide some recurring problems. So, with all these games and tricks and illusions, how can you, the investor, actually see through the noise? Well, this final section is all about building your toolkit so you can become an earnings detective.
First things first, you have to recognize when EPS is simply the wrong tool for the job. For some industries, it's pretty much useless. For real estate investment trusts or REITs, you want to look at something called funds from operations. For software companies, it's all about tracking annual recurring revenue. And for banks, you analyze their net interest margin. Using the right metric is always step one.
This quote from Warren Buffett just perfectly nails the mindset you need to have. For years, he has criticized this obsession with adjusted earnings that add back real expenses like depreciation. His argument is simple. Depreciation is a very real cost. It's the money you have to spend just to keep your business from falling apart. Focusing on numbers that ignore real cash costs, well, he says that's just living in a dream world. So really, the big takeaway here is to have a checklist. Don't just look at that headline EPS number and stop. You have to ask the next questions. Is that number backed up by real cash flow? Are the share buybacks being funded with actual profits? Or, way more dangerously, are they just taking on new debt to do it? Are the adjustments they're making actually legit? And finally, how does the number stack up, not just to the official consensus, but to that whisper number and to what their competitors are doing?
So from now on, the next time you see a headline flashing some huge earnings beat, you'll be able to stop for a second and ask the right question. Is what I'm seeing a sign of real, sustainable value being created? Or is it just a beautiful, very carefully constructed illusion?